Again, my name is Michael Mirando, Tremblay Financial Services. Exciting thing is that we're going to be celebrating our 25th year as a company here in Santa Barbara this year. Very exciting times for our company. To Jennifer's comment, I am married and have 4 children and empty nest, now grandfather. So exciting times for the Mirando clan. With that being said, I think that the topic of the conversation today is how do we create tax deferral on the sale of highly appreciated assets? And I'm going to bring a high-level screen here for you to kind of see the topics of where we're going to go between what Justin and Brett and I are going to talk about today. I'm going to lay a foundation for it, and each of us are going to share some thoughts and ideas with you on what we believe about each of these topics. What you see here is a highly appreciated real estate and tax deferral conversation. As we look at the different categories that we have at our fingertips, at our disposal as trusted advisors, there's actually 13 different strategies that we have available to us with varying degrees of success. What we're going to talk about today is 5 or 6 of them that really have the most horsepower and that we feel can have the greatest benefit to you and the transactions with your clients.
And usually they're just kind of supporting.
And so what we have here is the 1031 exchange, which all are very familiar with. And so what we're going to talk about a little bit is the 1031 exchanges you understand. Direct ownership of real estate to direct owner of real estate, tax deferral, etc. There's always pros and cons to each one of these. Second one that you see there, 1A, is a Delaware statutory trust. Delaware statutory trust is also direct ownership of real estate, but it's a passive ownership with all the benefits of real estate ownership. The opportunity zone, a little bit lesser in this tax deferral, but it is real estate to real estate, direct ownership to passive ownership. Pros and cons in each one of those. Going to number 2, intermediated installment sale. Some of you may have heard in the past, it was branded underneath the deferred sales trust. And basically what that is, it is a seller carryback financing strategy with the use of a trust, that ability to take real estate to cash. And that's both for commercial income properties, as well as, wait for it, residential income properties. So this is one of the strategies that we have where we can take and convert primary real estate ownership in a residential home to cash. Story coming on that here in a little while. Then kind of one of the lesser but still very, very powerful solutions is the charitable remainder trust. And so if an individual is charitably minded, this is a very, very powerful tool. And that takes real estate to cash again. And then last, as you see there, you can pay the tax and move on. As you all know, right now we're probably $30 trillion in debt. If you choose to pay tax, my children's children will thank you for that. So let's just not go there. Having said that, what I will do is I kind of laid the foundation in the overview. What I want to do is pass the baton to Justin to kind of talk about number 1. And then Brett and I will, kind of share our thoughts after he's had a chance to really kind of give the overview of that part of the market.
Awesome. And Justin, just thank you so much, Michael. And then Justin, if you can just tell us about yourself and what you do over at Radius, and then jump in when you're ready.
All right, sounds good. Yeah, so my name is Justin Diem, associate agent at Radius Commercial here in Santa Barbara, originally from the small town of June Lake. So Santa Barbara surprisingly feels like a pretty big town to me, although many feel a little bit differently. So diving into some of the more traditional 1031 exchanges, that Michael was referring to, wanted to highlight some of the local deals that have happened here recently, just to kind of give an overview of what we're talking about when we're discussing net leased investments. There's so many different types of commercial real estate that you can invest in. And one of the most attractive ones is the triple net leased investment. And a lot of people, hear the term triple net, and it's really hard to understand for, people that aren't experienced with it. But from an outside perspective, basically what it means is the tenant themselves is taking on a lot of the operating costs of the property themselves. So the triple net is where the tenant pays for property taxes, property insurance, as well as the maintenance and repairs of the property. So as far as a more of a hands-off type of approach to investing in commercial real estate, these are the type of investments that you would want to be looking for. This would be a little bit different than something like an office building where you have 10 to 20 different tenants and a lot of management that goes into play. We're thinking more of single tenant type of buildings. And here locally in Santa Barbara, we honestly don't have a ton of these type of properties. And when you hear the term net leased investments, you're going to be more thinking like a Starbucks or a fast food type of restaurant, where the tenant is just there for a long-term period, but is taking on all the operational aspects of the property themselves. Here in Santa Barbara, although we do have a number of single tenant buildings, they're few and far between and therefore very valuable. So wanted to start off with a deal that happened back in 2000. Oh, hold on, let me see here. There we go. Back in 2016, the AutoZone out in Goleta. This is an interesting one just because the price point here. It's a relatively low price point, so it opens up the investor pool for this type of asset and therefore very attractive. But this property was purchased back in 2016 for $2.75 million, and the lease was signed in 2017, and then the owners that signed that lease sold it for $4.9 million. And the reason I wanted to highlight this is because it shows just the pure importance of the lease terms themselves. And so what's a little bit different from the commercial side than a residential type of investment is really the lease terms are so incredibly impactful on the value of the property. And we're so much more focused on what that property, the income that's actually produced from the property versus just the market appreciation. And the reason for this is because of how long-term these leases are. These leases are, the AutoZone was a 15-year lease. And therefore gives that ownership basically the AutoZone's guarantee of paying that rent for the next 15 years. So that's a one quick smaller deal that happened here locally in recent history. Diving into some different types of deals. The Union Bank up in Montecito was a very unique property just because it was purchased in 2006 for $5.2 million. In 2008, they signed a lease with Union Bank, obviously a very large company, international bank owned. And so they then did a large remodel on the property in 2009. And then a combination of that remodel and the long-term lease signed, they are able to sell it for $16 million. I put here that it sold also in 2019 for $13 million. And I wanted to highlight this is because it also shows how impactful the triple net lease can actually be on an investment property. Since it sold in 2013 and there was basically half of the term was already complete by the time it sold again in 2019, it lowered the value because the guaranteed income on the property over the next 10 years was lower. And simultaneously, it was subleased to Luca, who is currently there. I think it's the furniture and design company. And so that sublease actually devalued the property because the new owner saw it as, basically Union Bank saying, hey, we're we don't plan to occupy this building long term. So it hinted that that may not, past the 2028 expiration date of the lease, it's actually they may not continue being a tenant there, and therefore then the landlord will have a big decision to be made. So just continuing along, 2 more deals. Don't want to go too far into these, but also just hopefully it resonates with some of the local perspective that you guys can have in investing in these passive type of real estate income. So the Whole Foods purchased in 2003 for 10.68. When the lease was signed in 2008, the owners of that property, obviously, and all of these deals that are mentioning require, quite a bit of investment to get the tenant in there. But it then sold for $35 million in 2012, and then once again sold in 2019 for 43.8. So you see these big appreciations in this asset, but they're not necessarily coming from a comparable sales or market comparison approach. It's all coming off the lease income that is in place on the property. And so it's so impactful to have a long-term lease in place on a property, and a grocery store, obviously, as we saw in COVID, was a pretty good place to be. And then wanted to finalize with the Amazon building in downtown, because this was such an interesting deal for so many people to see, because it was purchased in 2018 for 18.5. And I believe when that owner initially purchased it, he was looking at doing some sort of residential development or mixed use of some kind. And then Amazon came knocking, and they perfected a deal in 2018 and quickly sold that in 2020 for over $36 million. Obviously, to make that happen, the owner also had to put a lot of money into the property and provide significant tenant improvements to bring in Amazon, but they are guaranteeing a 10-year lease there. And so a new buyer was able to come in and purchase that for a large number, but hopefully some of your clients have that type of money, and we're in a unique market where an asset like this is extremely rare. So hopefully that kind of gives some insight into some of the local deals here. I think it really comes down to the leases on these properties to understand how important the tenant is. And when you have someone with really solid credit, think of someone like a Starbucks or even like an In-N-Out that rarely those properties are sold. But when they do, the ownership is no longer really a landlord. They get to sit back and take the operating income off the property while the tenant takes a majority of the responsibility. So hopefully that gives a little bit of insight on the net leasing investments, and of course, happy to answer any questions. And I'll let Michael and Brett dive into some of the more interesting tactics for tax deferred investments.
Awesome. Justin, thank you. It's clear Santa Barbara commercial is a great place to invest.
Awesome.
So at this point, Michael, I'm going to ask you if you can toss your other slide back up there. And then Justin, if you could introduce yourself to us, sorry, Brett, if you could introduce yourself to us, tell us what it is that you do at Channel, what you specialize in, and then we're going to start out with a question for you. So go ahead.
Yeah, perfect. Well, Jennifer, thank you for having me. Thank you to the group. I'm a financial advisor, wealth manager with Channel Wealth. We're an independent firm. We manage about $750 million of mostly local Santa Barbara assets. We work with high net worth individuals, nonprofits, corporations. We really lead with financial planning. And as most of your clients in town are wealthy, mostly from real estate. So it's a question that comes up quite often. A lot of our clients are moving into retirement and they're sitting on a lot of real estate. And as Michael mentioned, one of the most important things is deferring tax. we live in a state that is a high tax state. And so people are looking for ideas to defer that tax. So when I talk about financial planning, I'm really looking at the overall situation. Some people are selling businesses, they're selling investment properties, but they really want to understand their roadmap and path through their entire retirement years. So what comes up a lot is folks that have investment properties where they don't necessarily understand the tax ramifications if they were going to sell. A typical example is someone that has owned property for several decades. They have benefited from rental income, and their CPA, without their understanding, has depreciated that property to essentially zero. So what I come across is folks that are going into a sale of real estate, not understanding they're going to be taxed essentially on all of the proceeds of that. So it's a huge tax bill. So first and foremost, just understanding the difference between cashing out and deferring into some type of exchange property where they can essentially convert from being a landlord into what we sometimes call mailbox money, where you're just collecting paychecks from a real estate investment. So you become an active investor in real estate to a more passive real estate investor.
Thank you.
And I'll pause there.
Okay, thank you. Michael, I'm going to jump back up here to you. Can you explain some options for folks that are interested in an exchange but no longer want to be a landlord?
Yes, and so let me go back to this. I'm sorry, I couldn't get the mute off there for some reason, but basically in so many words, let's go back to this screen here. Okay, so right now, where we're really going with this is kind of 1A, number 2, and number 3. So those are kind of the 3 main horsepower solutions that we have. To be very specific, Brett did a great job of kind of laying the foundational work for passive ownership, where we go from direct managed, direct owned real estate to now direct owned, but using the term mailbox money, we are no longer actively involved in any of the management of that, and we literally are just receiving cash payments in the form of basically rent distributions. With all of the underlying benefits of direct ownership of real estate, with depreciation, the ability to write off and to tax, protect some of that deferral on and recreating a new depreciation schedule. So all of the usual things that we have for the benefit of owning real estate. But instead of being actively, we are now passively involved. And so one of the things that we, Brett and I look at, and this is probably the one is the really neat things that we can do is think of a highly appreciated asset. And maybe the question to you, Justin, is when we're talking about the basic cash on cash contribution to property owners, we're thinking that right now, rental income properties are capitalizing somewhere between 2 to 3% cash on cash in pocket after expenses and then before taxation. And so with highly appreciated real estate, we are getting the benefit of cash flow that's based off of like all of the examples that Justin gave based on the incomes that we're getting off of those properties. And it's not reflective in the cash on cash of the current market value. And so what some of these deferred sales trusts, the Delaware statutory trust can bring to our table is to capitalize and memorialize the current market value. Some of those were extraordinary. Use the Amazon at the end, it's $36 million. If you could get 4 or 5% cash on cash in your pocket on 36 million versus the 18 million, you as a property owner are benefiting extraordinary from those different valuations, right? And that's one of the benefits that going to a Delaware statutory trust property at this high valuation and the top of the market may make good business sense. And so that's the one where we're going real estate to real estate. And then just real quick into the intermediated installment sale is doing the exact same thing, immortalizing the value of the current market value of the real estate and then turning it into cash and then coming up with alternative solutions to be able to create the type of income that you'd like to have created. Without going too much into that diversification process, I'll just try and keep it high level. With that being said, back to you, Jennifer.
Okay.
Jennifer, could I just
please do.
add on
Yeah.
to that just a little bit? One thing that clients ask a lot is about ticks. And so this came about in 2006, around 2006, the DST option. And if people recall, ticks had issues where everybody has basically a vote. And so there's a lot of gridlock in managing a tick. And most people know ticks, tenant in common type of deals. So the DST takes that issue away of having kind of gridlock and everybody having a say. So you're truly a passive investor, but there's also downsides to that. So for example, a lot of the DSTs will set up leverage with a 10-year time frame. A lot of the deals will roll or have some liquidity event about 5 to 7 years, but they can go as long as 10 years, at least a lot of the deals that we've been involved in. So you really are stuck for 10 years. You have no liquidity. You really are at the mercy of the sponsor company. And when I say sponsor company, it's essentially the manager that's underwriting the deal and continuing to manage the deal. Yes, you're getting mailbox money, but there's also issues when there's times of economic turmoil. A great example is early last year, a lot of the DSTs, they lowered their income. A lot of them were paying 5, a lot of them are now paying closer to 4. So it's making sure people understand that you're still invested in real estate, but there's still some risk. A great example is the financial crisis. I mentioned these DST sponsors started in 2006. There were about 40 sponsor companies that offered DSTs going into the financial crisis. Coming out of the financial crisis, there was about 4. The reality is there's a lot of pop-up organizations that try and offer DSTs. You really have to make sure that you understand the risks. You're working with a good sponsor company. You're focused on commercial real estate that has a good future. So when we're looking at deals, and I'm sure Michael's looking at the same thing, we're not looking at necessarily retail or hospitality. We're looking at things like distribution, warehouse space, e-commerce, apartment buildings, things that are going to be resistant to these economic cycles, but to make sure the client is willing to be tied up for easily 10 years.
Great. So I guess my question to any and all of you is, and I really, sorry, no, I don't have a good understanding of this, so I just want to learn from all of you. So you're saying that a way to transfer the equity in a property. So if I'm a property owner and I want to sell my real estate and I've got even $2 million in gains that I'm looking at taxing on, is a Delaware statutory trust some way to move that into, if I wanted to buy a piece of commercial real estate, is that a possibility?
Well, I'll start, Jennifer. There's still a lot of rules around exchanges. You still have to have a qualified intermediary. There's a few good ones in town. We usually work with Amherst Exchange. There's certain rules. You can't go to a lower leverage level when you go into one of these DSTs. Typical situation is folks that have an investment property and they've already paid down most of the debt. And so they can roll into a DST as long as the debt inside the DST is higher than their existing property. Okay. There's certain other things to keep in mind. When you're going into a DST, there might be exposure to different properties in different states. So one thing that catches people off guard is you go into a DST, they own property in Texas and Denver and Nashville, which is kind of the key places that we're looking at. You have to file taxes in each of those states. You're now an investor in property in all those states. But you're absolutely right. The idea is to just defer taxes. One thing we're always looking at, if you own a home here, the cap rates are usually about 0. So one of the things we're looking at is cap rates that can get us 4, maybe a little bit higher than 4%. So it's a win for the investor because you're converting a property in Santa Barbara, for example, that your cap rate is almost 0. Inflation's 4. We want to get something close to inflation, if not higher. So we're looking at deals in states that have population growth, job growth, and just good opportunity.
Thank you. So Justin, running back to you, what are some currently attractive sectors of the commercial real estate market? And maybe you already touched on them, but are some of the opportunities that you listed situations in which people were tenants in common, or they purchased it through a DST?
I believe a majority of these here locally were private investors. That being said, I think Brett, hit the nail on the head by looking at resistant type of assets, stuff like industrial that goes for, e-commerce and data centers and those type of things. And as far as, and apartment buildings are all great examples of commercial real estate assets that most people could look at. However, Santa Barbara is much different than so many different markets. And so you're looking, a majority of the sales that we see here locally, especially, under 10 million, are going to be private local investors or proven buyers in this market that know how to kind of work the local landscape as far as regulatory and building and all those different aspects. And so investing in some of the local real estate, it definitely adds a level of hands-on that you do need. Some of the examples that I listed out were, it was all the work before the current buyer that was put in to get them to that place where they could sell it to the high number, and then it becomes an investment where people are a little bit more hands-off and the building continues to operate. But I believe something like the AutoZone, where it was older property and then signed a great lease and did a nice little upgrade on the building, and then it becomes a much more significant investment at that point. But rarely do we see individual properties kind of invested into, and from a DST perspective here locally. That being said, so that's where you're going to look at more metropolitan areas or growing economies where Santa Barbara is just a unique town, and probably one of the reasons we all live here.
Thank you. So Michael, can you tell us some of the income strategies that you use for your clients aside from real estate? And I would love a real example. When you and I were talking, you gave me some good hands-on examples of things that you have done to people, and sometimes it doesn't always work out. So let me know about how you qualify somebody for a situation, and some anecdote if you could.
Sure, thank you. Yes, so where we're really focused right now is on real estate. And as all of you know, real estate is a very, very significant part of a diversification of a portfolio. And we always encourage that. And on a personal case-to-case basis, the diversification of your portfolio, each of those concentrations are based on what is, best for you as an individual investor. So we always have a piece of the pie that has some type of real estate related income based and growth, total return type play. But then since we're Series 7, Series 66, California Life and Health, wealth managers, it gives us the ability to look at a broader diversification using stocks, bonds, mutual funds, in certain circumstances, life insurance, long-term care, annuities. All of these are tailored specific to you individually for your own personal financial position. But when we start talking about going from real estate to cash, like in the intermediated installment sale or the charitable remainder trust or the donor advised funds, each one of those types of structures are going to allow us to use stocks, bonds, mutual funds. And then when you start doing stocks and bonds, we're talking about both growth and income related style investments, depending on what your need is at each given time. And so right now, some of the places where we're seeing a lot of money go is going into preferred stocks, because there's some really nice dividend paying preferred stocks out there, I think 5, 6, 7%. Some of the high yield bonds, even some of your income producing mature dividend paying stocks are a really nice place to be right now. And so what we promote is not only within your real estate concentration, broader diversification into the market, utilizing all of the different strategies that we talked about.
You're muted, Jennifer.
Thank you. Did anybody want to add to that?
I'll add just a little bit. Michael hit it on the head in terms of a lot of different options. We also look at a lot of insurance wrappers to provide lifetime guarantee income for folks, especially the more conservative folks. I think what's really important, though, is going back to some of my earlier comments about financial planning. The observation that we come across quite often is people are overexposed to real estate generally in this town. And so we don't want to load them up with too much stuff that's illiquid. So we're always looking at ways to produce income that's tax efficient, but also gives clients some liquidity. In addition to the Delaware statutory trust, we do look at a lot of other real estate deals that have some liquidity option. We also do some creative things in the structured note world. My background is working on Wall Street in the bond shop world. So I do a lot in the municipal bonds, corporate bonds that can provide some liquidity, but also some good tax efficient income.
Thank you. Brett, you touched on this a little bit. I just want to make sure we covered all the options. One of the questions was, are there methods to avoid a tax hit when selling fully depreciated real estate other than a 1031? We talked about DSTs. Is there anything else to avoid that tax hit that we did not touch on?
Yeah, unfortunately, there really isn't. Unless Michael has an idea that I don't, but I think what you can do is pair it with some other strategies. One thing that we do that Michael had on his sheet is donor advised funds. And so essentially a donor advised fund is something you can incorporate into the planning when you are selling real estate and taking that big tax hit. What a donor advised fund is essentially like buying an annuity that will pay you for life, but gives you a huge upfront tax deduction. So if you're selling real estate for $1 million, you might have $150,000 to $200,000 in cap gains. You could pair that with putting some money into a donor advised fund to offset that initial tax hit.
Michael, did you want to add to that, or did we?
Yeah, maybe this is time for the anecdotal story of a transaction that we just worked with. One of our new clients was back in October, the sale of a primary residence of an 85-year-old woman who was needing to vacate her primary residence, which if you put those numbers in there, probably bought in the early 60s at $15,000 to $30,000. It's now appreciated to $3 million, and in essence is a 100% taxable event. She needed to leave her primary residence for the purpose of going into a long-term care facility due to cognitive dissonance or, cognitive decline. And in that transaction, in essence, she had to pay $1 million worth of taxation. So where an 85-year-old woman who's at that stage of her life where she really needed to be able to maximize the income producing feature of her primary real estate, she ended up giving 1/3 of that money to the government. Had you, I'm talking to the broader group of realtors out there, you guys in that transaction have been able to bring myself or Brett into a conversation with this client, in essence, we would have been able to utilize $3 million in that transaction. And in essence, instead of, in so many words, generating roughly $100,000 a year in income, we could have generated in excess of $150,000 in income for this individual. And also, by the way, creating an additional legacy asset note for the passing, when she passes away, to the estate. And so I guess we're trying to, by this education, we're trying to invoke to you all that if you are in a situation where you have a client with a highly appreciated asset in real estate, be it primary residence or be it that which is a residential income or even a commercial income property, please pick our brain. Please allow us to share what the benefits might be to your client. I know you all are dealing with very sophisticated clients, but in this particular case with this 85-year-old woman, we could have in essence changed her life and created a better legacy for her family. And so in that thought, this is one of these things where as we look forward over the next 3 to 5 years, we're going to be sunsetting a lot of estate limitations. Right now, it's, for an easy number, $12 million per individual for husband and wife. But that's going to sunset. And we almost had that pressure on us here recently at the beginning of the year. It's been delayed. They were going to decrease that exclusion. So a part of what Brett and I do in this financial planning is trying to create that legacy passing of assets to the greatest extent for our estates. And so, as all, we're all trying to create wealth and pass generationally, and if we're really good stewards to our children's children. And I think the strategies that Brett, Justin, and I have available at our fingertips are just those types of things. So in these transactions, we'd love for you guys to be thoughtful. Love to have, us to be engaged, at least if nothing in the planning circumstances, because another transaction that I was just a part of was a buy-sell. And so the realtor was able to sell a property, 1031 exchange into a new property. And just the only accretive benefit that I brought to the transaction was the ability to take the buyer's remorse, the buyer's hesitation out of the transaction, because Brett and I can detail very specifically what the proceeds are going to be from one transaction to another, and can take a lot of the confusion, a lot of the cognitive, I use dissonance with these decisions, because we can take the ethereal world and make it very concrete and convey that message to your buyers and sellers, and hopefully make the transaction that you're in currently even easier and a more positive outcome. Brett, would you say that that's kind of part of what you're trying to do as well?
Yeah, absolutely. I mean, I think having a financial plan kind of leads you to some really good decisions. Great example is a lot of folks forget that investment properties have a huge step up for their heirs. And so you have someone that needs money, has an investment property. The worst thing you can do is just sell it because you need money. There are other ways to leverage that property in order for the next generation to inherit it at a stepped up basis.
Right. Thank you so much. So I'm going to ask this last question to all of you, and then I've got one question in the chat box I'll get to. So if anybody else thinks of questions, please put them in the chat box and I will get to those. But last question, and Justin, I will start with you. What are your predictions for the commercial sector for interest rate and the implications for real estate and other income strategies?
I mean, there's definitely no doubt that increased interest rates is going to have some impact on commercial investments in general. That being said, we have so much cash and so much exchange money that's currently in the market or trying to be placed in the Santa Barbara or Central Coast in general, that we're still going to see a huge demand for properties here, and across the board. We here at Radius, whenever we have sales meeting, it's just an endless slew of exchange buyer needs that we hear. Anything, it could be 2 million or it could be a $50 million exchange that is looking to place money. And so, interest rates are definitely going to have an impact on probably some of the larger deals, but there's still plenty of exchange money out there to continue pressing the market forward. The one caveat to that, I would say, is more from an owner user perspective, like, say a small contractor or something like that, that's trying to buy a $1 to $2 million small industrial property to run their business out of. They're going to be impacted a little bit more by those interest rates just because of the higher loan payments. But as far as pure investment, there's still a lot of cash in play here.
Thank you.
Of course.
Yeah. Michael and Brett, do you want to comment or should I move on to the questions in the box? Questions. Okay. So how about inheriting a property, parent-child exclusion? I'll start with Michael.
Right now, I think the pressures that you're seeing with Prop 90 and Prop 19 and Prop 60 is putting a lot of pressure on real estate in that fashion. What we see right now for families that have multiple residential or multiple income properties, there's pressure that there is going to be a step up in taxation. There is going to be a step up in basis. I alluded a little bit to the estate exclusion that's currently at 12 million per married individual. That's going to sunset down to 6 million in 2025. There's pressures currently in the administration and some of the initiatives that are in Washington are already trying to push that lower today. We don't think that's going to happen, but at the end of the day, to Brett's and my consistent comment, you got to get in front of this. You got to start planning now. You've got to really get your clients, as sophisticated as they are or are not, to get into conversation right now. The amount of pros and cons that go with, if I have, let's say that I'm a family of 4 and I've got 4 residential income properties and the primary residence is going to go to 1 child, they're going to get step up in basis. They're going to be able to keep Prop 13. But for those of the balance of the children are going to get step up in basis, depending on what the estate exclusion is. And then they're going to have a full step up in taxation. So these are things that we need to start putting in place. A lot of the tax deferral strategies, different types of estates, just types of remainder trusts, different types of strategies that we have available to us for the estate planning piece is something that I am been screaming at the top of my lungs for the last year to a year and a half to say, get in front of it, team. Do it now. Don't wait. Start the dialogue. It takes time to take place. We almost got, we got caught, off guard this time last year as they put these different propositions into play. I think we're going to see some changes coming up here in the next election come in that November timeframe. We're going to see some pullback on that. So guys, get out and vote. Start screaming, start yelling. You guys, this is the world that you guys are living in. Let's get in front of this. Let's make this go away. This is not right. There's got to be an even keel balance. But I think you guys are out there that should be the leaders of this. And so, again, soccer player, the yellow flag's up, maybe see the red card come up. I don't know. Let's get in front of this.
Thank you. So I will say, as I run through these questions, I want to make sure we get to all of them. Simi asked a question, how much lead time is required to introduce you to our clients? Example of the 85-year-old woman. And I think it's been clear that's now, soon as possible.
Yes.
Would you just, is there any time frame, Brett, would you say?
Yeah, it's really important to think about this early on. So you have a 45-day window to identify an exchange property. So the same goes in this DST world. You still have 45 days. And then you have I think it's 135 days to actually close on it. But you certainly have to, before you even list your property, to be thinking if you're going to do an exchange.
Great. Todd has a question. Brett or Michael, do any of these tactics help if the seller of an exchange property has, quote, money left over as they exchange into another investment property? Example, exchange a property at 2.8 million, exchanging into a 2.4 property, and will have to pay capital gains on 400,000.
Yeah, this is actually a good question to ask, because one of the ways the DST has been really good for our clients is it's a fallback plan if you cannot identify a property. And if you do find a property and it happens to be a smaller property, they call it filling the boot. So you can essentially go into, you're still using a QI or qualified intermediary, but within the DST or the exchange process, you can use a DST for the piece that doesn't fit into the exchange property. So it gives you a lot of flexibility.
Great. Any addition to that, Michael?
No, well spoken. That's pretty much that's probably our biggest tool that we have in our tool belt for that. Reapplication of boot. But one more point I would like to put on there. We've been talking about concentration, and Justin, to your comment, yes, we have a lot of local Santa Barbara real estate. Yes, it's extraordinary. Yes, but if I have a $20 million building in Santa Barbara, I am directly concentrated in one building in Santa Barbara. The Delaware Statutory Trust allows us to broadly diversify across multiple states, across multiple vertical markets, and gives us the ability to take that concentration off the table. And so again, there's a lot of nuances, a lot of pros and cons that we have here on the different tools that we have available to ourselves. And so, you know, maybe in this, I hope what this is going to do is going to spur more transactions for you all, close more transactions for you all, and kind of open up your mind to different alternatives that are truly available to you, even if your focus is on primary residential real estate. You know, Justin and Brett and I deal with a lot of commercial real estate as well too, and a lot of you out there are commercial brokers. But I would implore you to, you know, get together with us, spend a little bit of time kind of just coming up with some of the different ideas that we have to help you get more gross closed transactions. We would love to see 2022 top of the market. We like to see you guys scrape winnings off of that market right now. You know, fuel more transactions for Jeff and team. They want to see a little bit more money go through the organization there. So, and Miss Liz, but what I will say to you is that there's a lot of different solutions out there if you're willing to entertain them. What do you say, Justin, Brett?
Yeah, I think what's important to echo Michael's comment is the coordination of professionals. I think we try to do a really good job of being in communication with the CPA, the estate attorney, and you're the other piece of the professional puzzle. Important on the DSTs, the regulators in our world actually require the CPA to sign off on it, just as another check and balance to make sure it's appropriate for the client. So having a realtor, the lender, the CPA, the attorney, and the financial advisor all on the same page, it makes us all look smart to the client.
Thank you all so much. I think we got to all the questions over there.